Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Today's video will bounce around a little bit. As I was recording, I realized there were several different things that I had in mind. So what we're going to do is jump around to a few different topics. We'll talk about inflation. We'll talk about the pump in risk assets. We'll talk about what's going on in the brewing European energy crisis. We'll talk about expectations for Fed rate hikes and try to marry all those together into some cohesive idea. So get comfortable. We've got a few different things to discuss today. If you enjoy this content, make sure to give my video a thumbs up and subscribe to the channel. And I have an announcement for you guys. Yesterday was the launch of my premium newsletter. I've gotten a lot of requests to provide more content over the last few months, and I've been really missing the written word in making these videos. I'll continue to put out content here on YouTube, but I've really been wanting to write more extensively, and this is my attempt to do that. So you'll find a link in the description down below to the first edition of my Alpha Beta Soup newsletter. The goal for this publication is similar to what we've been doing here on YouTube, to talk about markets, Bitcoin, money, economics, labor, the whole pie, but in my own unique way. I'll provide interactive versions of my charts, which many of you have been asking for the last year. And it's also an opportunity for me to express longer form ideas, bigger concepts about the market, and share some humor and hopefully entertain you along the way. The first issue is free. I highly encourage you to check it out, see what you think. Most future issues will be for paying subscribers only. As I said, I will continue making content here, but I've really been looking to expand my footprint and give myself more ways to maybe make a living at this and do this full time. If you choose to support me and become a member of my newsletter, every dollar of the proceeds goes to me directly. So thank you for considering it. But with that aside, we have much to discuss about the markets, so let's just get right into it. So where do I begin? I guess we'll start with Bitcoin, as that's usually what helps to ground me when I'm trying to take in the market. And we can see it's up about 9% today. In fact, most of the market is up. If I go over here and look at ES, which is the S&P mini future, it has gapped up pretty solidly this morning, up about 1%. And it looks like the market as a whole is trying to find some upside here on this Friday, at the same time that we're seeing the DXY pulling back from a 20-year high. This is a 20-year high, going all the way back to here in October of 2002. Whenever the DXY weakens, particularly after a nice rally, a nice move to the upside, as it softens and pulls back, it's common to see assets moving higher. And that's because the dollar is the denominator of all of these assets' prices. So as the denominator weakens, the numerator strengthens. And recently we have entertained the idea that maybe Bitcoin is setting a local low. Maybe equities are setting a local low. We know that economic data is deteriorating. There's a very real possibility that the world will enter a recession sometime in the next 12 months. We don't know when that is. Some have made the argument that a recession has already begun. I've certainly entertained those ideas, though we haven't officially begun one yet. And the market is a discounting machine that looks forward. So right now, most of the information is known to the market. And with that understanding, it's possible that we can get some upside, particularly as the DXY is softening a bit here. Now, the ECB yesterday did decide to raise their target interest rate by 75 basis points. That also helped to soften the DXY because the euro is 57% of the dollar basket. So as it strengthens, the dollar relatively weakens. That helps risk assets. We've looked at a few different ways that this could be the low for Bitcoin, at least temporarily, the local low. We obviously don't know if we go below this in the future. I'm open to that possibility. I think there's a chance of that next year if we do get a pretty bad recession. But right now, short term, this does look really constructive. You know, on a lower time frame, we were able to hold these lows here from July. We tested them and found them as support. We've got this nice breakout here over the consolidation range. And when I look at this on a bigger time perspective, Something else that maybe suggests to me Bitcoin's local low will hold, at least for the time being, if we look at this in terms of a parallel channel. Here I'm using weekly closes. Now, when you have a parallel channel that's well established and it's broken out of, the move away from the channel is often equidistant to the height of the channel. We've got my arrow here. Go ahead and copy it, move it down over here. You see how well that lines up? In fact, I'll just copy this entire channel. We'll drag it down and we'll clip it to the bottom. Look at that. Look at that perfect capture here at the bottom of the channel, which also aligns with the 2017 all-time high. So we've got some confluence here that really reinforces that the market wants this level to hold. Now, if you'll recall from a video that I put out a couple weeks ago, where we really explored the Dow Jones and its relationship with its 200-week moving average, we also talked about how it had held its 200-week, which also aligned conveniently with the pre-COVID high, and that if we were going to see structure hold, this area needed to be well defended. Well, when we think about this in the context of what we're looking at here on Bitcoin, this is where that low is for the Dow Jones. There's a lot of confluence here, and it suggests to me that we can, for the time being, lock in that this June low will try to hold. Now, I don't know if we break down further from that. I try to emphasize that point to you guys because the global picture, the macro picture, is extremely volatile right now, and it can play havoc on any TA that we try to perform here. And it's also important to point out that I'm not making any trades based on this analysis here. I'm just trying to unpack this, look at it from different perspectives, give myself things to think about. And when I look at it from this angle here, I feel like this low is well defended, at least for the time being. And maybe that helps to support some upside. Now, next week, we get a CPI print. It comes here on Tuesday, September 13th. It'll be before the market opens. We'll get the CPI from August. If we look at the Cleveland Fed inflation nowcast, it thinks the month of August will be flat month over month, essentially no change. Now, we had the same thing happen in July. So if we get another flat print in August, CPI will probably be around 8.2. Now, in my recent video where we talked about inflation, we broke down what it would look like if the CPI kept giving flat prints month over month. We got one in July. It's possible that we're about to get one for August. And if we do, we can expect CPI somewhere in the neighborhood of 8.3, 8.2. And as we've discussed, because of the rate of change, because CPI is viewed as a year-over-year percentage change, even if nothing increases or decreases in price from now till Christmas, we'll still have a 6% CPI. We need to see prices coming down. But alas, this trend is positive. This is the trend the market wants to see. And regardless of how realistic we think it is that inflation may get down to 2% in the next year, I don't think that it will. The possibility that it would keep trending downward is a tailwind for risk assets. So if we get a softer CPI next week, if it indeed comes in flat month over month, we get an 8.2, 8.3% reading down from the 8.5 before, then we are improving. We're going in the right direction. Regardless of what I think about the long term, the market will perceive that positively. So when we've got this confluence being held here, and then we go look over on equities and we see a similar type of curling with different supports, I'm starting to feel confident that maybe we have started to turn on this down leg, and maybe we'll get a little bit of upside. As long as the DXY can continue to soften or at least not set new highs, it won't get in the way of a few days, maybe a couple weeks of upside on risk assets. If we look at Bitcoin's RSI for confluence, we can see that it's still very below here on a weekly time frame. We've started to curl higher. We've set a higher low, and we're nowhere near oversold. As we start going down deeper into lower time frames, we can see a similar trend, a higher low on the RSI, still some room to run on the daily. But on the 8-hour time frame, again, lower high, but we're starting to get close to oversold. And in some of these lower time frames, 4-hour, 2-hour, they look really extended. So maybe this rally starts to cool off here in the next day or so. But when we look at it bigger picture, it does seem like we've got some room to the upside here as long as the economic data cooperates. But what's really been on my radar and what the market seems to be paying the most attention to is what's happening over in Europe. There is a brewing crisis there, which we've explored at different times here on the channel. I've certainly been tweeting about it. And it seems like Europe is heading straight into a deep, severe energy crisis. Energy underpins all life. It's a non-optional input to society. It's required for prosperity and abundance and advancement. There has never been a society that successfully downgraded to a lower density form of energy and was prosperous. But we have world leaders in the midst of a generational shortage in energy arguing about whether or not it's a good idea to increase production of reliable sources of energy. It's almost unfathomable that we're still having debates in 2022 about the efficacy of nuclear power. It's the safest, cleanest, most effective solution out of this mess to provide energy security for nations that are facing these shortages. Thankfully, the new UK Prime Minister seems to get this a little bit. In just the first couple of days she's been in office, she already reversed a national ban on fracking to help increase oil production in the UK, and we've heard her talking about increasing nuclear power. These are the kind of conversations that are productive, that we need to see being had. The only true way out of an energy crisis is to create more energy, particularly when you've got a nation like Russia, which is one of the world's premier energy exporters, and energy is a non-optional input to society, as I mentioned. The only way to weaken Russia in this exact scenario is to dilute the market that provides them cash flow. Create more energy so that prices come down and you're not beholden on their sale. If we can see more conversations like this, I'm not making a political statement about fracking. I am simply pointing out that it is an obvious, glaring hole to me that countries are facing energy shortages. They have reliable sources of energy in front of them, and yet they are debating the efficacy of using them. If we can see more conversations like this evolving over the next few months, maybe Europe can avoid the worst outcome of this energy crisis. But another aspect of this that's playing a little bit of havoc is what the responses will be to various governments trying to address these runaway energy prices. As we're debating about the efficacy of increasing production, which as I have stated is the only true lasting solution out of this. One other observation that I've made and that I stand by is that if these governments do not take these costs onto the public purse, if they do not become part of the central bank balance sheet, citizens will revolt. Cold, angry citizens will grab their pitchforks and they will march on the government because you cannot have an energy shortage in the depths of winter. Society will not stand for it. And I knew that when I saw these energy prices here showing a 3x, 4x, 5x over the next few months, there's only really one choice for these governments, and that is to subsidize these costs. And that is what we're starting to see. We see citizens telling their governments these prices are unacceptable. This is a picture from the Czech Republic. These energy protests have been happening all over the world. They're happening in Sri Lanka, they're happening in Latin America, they're happening in Indonesia. I've been seeing news all over the place. But right now we are focusing on Europe. It's happening there. 6 in 10 British factories are at risk of going under because of high energy costs. COVID-style bailouts for energy bills are being considered in the UK as they're warned of civil unrest, literally what we have been talking about. This was a few days before Liz Truss became Prime Minister. You can see this is from late August. And then this story here from just a few days ago, Sweden announces emergency support for energy producers. There's a dozen other stories like this that I can show you guys that are happening around Europe, but all these governments are starting to understand that they must step in, they must subsidize these prices, or else they'll be facing civil unrest. What that means is that we are facing more currency depreciation. As these costs make their way onto the public balance sheet into these already deficit-heavy nations, that cost of those expenses will be expressed through a dilution of buying power for savers of the currency. Those currencies will be debased. It's almost the only way that they can handle this situation is to print money they do not have to pay these costs. And as the world is facing this energy crisis, as we see the Federal Reserve tightening, we've also got the ECB trying to tighten, although it's following behind at a lag. It's creating havoc in the world of foreign exchange. World currencies are making shitcoin level moves. The major risk of all these central banks tightening in the midst of this energy crisis and having all these currencies make these big moves is that it raises the risk of a sovereign debt crisis. We have them every few years. years. They occur in different parts of the world all the time. But we're facing one on a scale that we haven't seen before, one that would involve developed market economies. Countries in the Eurozone, the United States, Japan. Some of these sovereigns are facing very risky conditions. And you can see some of that manifested here on this chart of all these different currencies. Up here is the euro. You can see it's softened a little bit because they raised rates yesterday, which strengthened them relative to the dollar. But if you look at some of these other ones, here's the Japanese yen, the Chinese yuan, the pound sterling. Over here, Taiwan, the new Taiwan dollar. All of these are pushing higher. This is on a weekly chart. If I go down to a daily, you'll see some of them have softened as a result of the rate changes yesterday. But on a weekly time frame, they're still pushing to new highs. And the major concern is that 3 of these circles here on the left, these are the 3 largest holders of United States Treasuries. These are the 3 largest foreign owners of US debt. Taiwan over here is the number 10 holder. So we've got 4 nations in the top 10 of US Treasury holdings, all of which are watching their currencies rapidly depreciate versus the US dollar. That is a very bad situation. So if the Fed is going to continue tightening, continue raising interest rates, it will force these other central banks, namely in the Eurozone and in the UK, to continue tightening to keep up with these efforts, because otherwise their currencies will get left in the dust. Now, one thing I do like to look at is the Fed funds futures market. I like to see where those traders are anticipating rate hikes over the next few months. It's not always super accurate, but it's a good measure of sentiment. So what we're looking at here are a couple of the upcoming Fed funds futures contracts and the 2-year Treasury yield. So this gray line is Fed funds. This is what will go up if they raise rates at the FOMC. This red line is what the market thinks the rate will be in October. The blue line is in November. The yellow line is December. So what we can see from this chart here is that the market is expecting a 75, 50, 25 parlay of hikes over the next 3 FOMCs. From now till October, that's 75, that's 50, that's 25. Now, that seems all well and good, but there's something we need to point out here. The 2-year yield is in the way. The Fed fund rate should be below the 2-year yield under normal conditions. The 2-year is further out on the yield curve. It's a higher duration than the Fed funds rate, which is an overnight rate. And so naturally, the 2-year should be above the Fed funds rate, offering a higher return for taking on risk for a longer period of time. However, the 2-year is in the way of the November expectation for hikes. So let's game this out here. We get to the FOMC on September 21st. Let's say the Fed raises 75 basis points. Let's say the market is dead right and we're up here. Then we get to November. The Fed decides, hey, we need to raise 50 basis points. Well, that puts them right up here at the 2-year yield. Now, why does that matter? Well, if you go back 40 years, every single time that the Fed funds rate here in red has touched the 2-year yield here in black, it has been the end of the hiking cycle for that period of time. Over here, Fed funds broke above the 2-year, end of the hikes. Happened here in 1995, happened in here in 1999, 2000, here in 2006, here in 2018 and 19. I have shown you this chart before. Will we get this trend again? It's something to be watchful of, because if this 2-year Treasury can't get out of the way and it can't push itself to new highs, because if you look at it here, if I move these other things out of the way, you can really see it has been struggling to get over 3.5. 3.45 was the high from June. It is above that, obviously, but it's been more sluggish. You can see it's losing some strength. If I throw an RSI on here, you can see it's kind of withering in its momentum a little bit. It's starting to soften. So can it get much higher? Can it push itself up to 3.6, 3.7, maybe even 4%? That seems hard to fathom at this current juncture. Not impossible, but difficult to achieve. So if the market is reading this correctly, if they have any accuracy to them at all, it looks like the Fed may hike us directly into the 2-year Treasury, at which point it becomes a guessing game. Either the Fed will pause rate hikes, as they have done every time for the last 40 years, or they will put us into uncharted waters. Waters for which we do not have a model. That gives me pause, but it's important to point it out to you that we need to keep our eye on this over the next couple of months. Depending on what happens at FOMC in September 21st, we might start seeing these values shift. Maybe we see the 2-year push higher. Hard to know just yet. And as the Fed continues to tighten, and as they force these other central banks to also tighten, who are seeing their currencies depreciate versus the dollar. What that does is it raises their import and trade costs, those other nations, and it makes them far more likely to want to sell US Treasuries so that they can get dollars to perform trade, pay off their debts, and operate as a nation. So a strong dollar is not a good thing. It creates solvency pressure upon the rest of the world who needs those dollars for trade and commerce, because the dollar is the world reserve. Essentially, treasuries are the world reserve asset. And when we have a dollar strengthening and forcing all these big moves in currencies, other countries become far more likely to sell those treasuries, which helps to push yields higher and push interest rates on treasuries higher, all of which further tightens the global economy. So we're creating a feedback loop here. This is partially the dollar milkshake theory by Brent Johnson, that as the dollar strengthens, it belies more dollar strength, becomes a self-reinforcing mechanism. You can see that relationship between the dollar and foreign-held treasuries on this chart here. The blue line is the broad dollar index, which is basically the DXY, though it is slightly different. And this red line represents US treasuries that are owned by foreign entities held at the Federal Reserve. And the relationship here is an obvious inverse one. As the dollar strengthens in blue, ownership of US treasuries by foreign nations falls. As the dollar weakens, they lever up and buy more US debt. Then the dollar strengthens, they sell those treasuries to get dollars, again, for trade, for commerce, for paying down debts, to remain liquid. So as we see the dollar strengthening here in 2022, what do you know? Foreign held treasuries at the Fed are net declining. That pushes the dollar higher because it makes more people fighting over dollars. As they sell these treasuries, they are essentially buying USD. So it bids up the strength of the dollar relative to other assets. That raises the risk of a sovereign debt crisis as we continue to push this higher. These movements also limit foreign appetite for US treasuries. As you can see here, they're actually selling them. So their appetite to buy more of them in this environment is affected, which does play a role in the federal government's ability to finance itself. So if this spiral continues to deteriorate, if the dollar remains strong, if foreign entities continue to shed their treasuries in order to get those dollars and reinforce that loop, then as the US deficit continues to stagnate and grow, they will find it more and more difficult to find foreign buyers of their debt. It becomes more incumbent upon the private sector and the Fed itself to fill that role. And that is where you see debt monetization becoming far more likely. So we're seeing big moves in currency markets. We're seeing a Fed funds futures market that thinks that the Fed is going to hike us directly into the 2-year Treasury, at which point they will be faced with a 40-year precedent being broken if they do not pause hikes. Alternatively, this dollar strength may continue to force sovereigns to sell their treasuries. It also may give the Fed more room to raise rates if that is their ultimatum. In the shorter term, we see some constructive price action in equities, finding support here in the middle of a descending channel and gapping up pretty strongly here in the morning at the same time that we're seeing strength in Bitcoin and really across the risk spectrum. If we do get a lower CPI next week for the month of August, as anticipated, then there is a strong likelihood we may only see an 8.2, 8.3% CPI, which would be a second consecutive lower month, and that could be a boon to risk assets. Something I'm watching over the next few days. I think next week will be pretty interesting. And we will continue to monitor news events out of the Eurozone. The debates about how to navigate out of this energy crisis are only just beginning, though some of the developments we see in the UK may mean the crisis won't be as bad as anticipated if they can proliferate, if we can see more conversation about increasing production, not just implementing price caps and subsidizing higher costs. Those things are inflationary and they won't address the real problems. And that's really where we'll leave things today. We bounced around a lot because there's a lot going on, and I wanted to try to cover a bunch of different bases and show you the various things that I have at top of mind. We're getting some upside in risk assets. Maybe it can continue into next week if we get some supportive economic data. We also continue to monitor the European continent and how they're handling this energy crisis, which will affect the rest of the world. If we see more conversations about how to increase their capacity capacity, particularly on the nuclear side, then maybe we can stave off the worst parts of this crisis. But that is yet to be seen, and we have many more months to go. Make sure you're following me on Twitter, right here at TXMC Trades. This is where you'll find a lot of my thoughts and analysis, and I really look forward to engaging with you guys on social media every day. Just yesterday, I launched my premium newsletter. While I've really enjoyed making these videos over the last year and will continue to do so, I've been missing the written word and I want to write more. So I've launched this newsletter in which I will include my thoughts, my deeper observations about the market, my longer form ideas, and some interactive charts, as many of you have been requesting over the past year. The first issue is free to all. The link is in the description of this video, or you can find it on my Twitter profile. Most future issues will be for paying members only, so please consider subscribing. Your support means everything to me. It goes directly to me and would allow me to do this full time if things work out. I'm really excited for you guys to check it out. And that's where we'll leave things today. I hope this video was coherent. As I've been recording it, I realize we've been jumping all over the place. I don't know what it's going to sound like when I get done with editing, but I hope that I was able to lay out a picture for you about my key priorities right now. The market is a melting pot, and it isn't always super clear what to focus on, so we'll try to keep a broad, zoomed out perspective. And that's it. I've rambled for about half an hour here. I don't know how long this video will be, but I'll let you guys get back to your weekend. If you enjoyed my content, make sure to give this video a thumbs up and subscribe to my channel. So until the next time we speak, take care of yourselves, friends. Be kind to each other. Try to spend some time outdoors this weekend, and we will talk again next week. Cheers, everyone.